Oneok Inc. (OKE) is currently positioned as a de-risked leader within the North American energy infrastructure sector, benefiting from the transformative strategic acquisition of Magellan Midstream Partners. This transaction, valued at $18.8 billion and completed in September 2023, significantly broadened OK's operational scope, increased its liquids-oriented footprint, and solidified its reliance on highly contracted, fee-based cash flows. The resulting entity is poised for superior long-term shareholder returns driven by substantial, yet non-cyclical, growth opportunities arising from synergy capture and expanded market access. The analysis indicates a strong forward trajectory for OK despite the temporary elevation of financial leverage incurred during the acquisition. Consensus forecasts project an aggressive earnings per share (EPS) compound annual growth rate (CAGR) of approximately 10% between 2024 estimated and 2026 estimated, reflecting high market expectation for the realization of post-merger efficiencies and the successful execution of organic growth projects. Operational stability, a core strength of the midstream model, is evidenced by high-quality financial performance, including a trailing 12-month (TTM) Q3 2025 operating income of $5.91 billion and cash flow from operating activities (CFO) reaching $5.66 billion. A central focus for the investment case is the disciplined management of the post-acquisition balance sheet. Total debt surged to $33.73 billion TTM Q3 2025, resulting in an expected pro forma net debt to EBITDA ratio of approximately 4.0 times at year-end 2024. Management has established a crucial deleveraging plan, committing to reduce this ratio below the critical 3.5 times threshold by 2026, a necessary action to reaffirm and protect the company's investment-grade credit rating of BBB from S&P and Ba3 from Moody's. The dividend is fundamentally secure, supported by OK's long-term contractual revenue base. The current annual dividend of $4.12 is robustly covered by the distributable cash flow (DCF), with a coverage ratio estimated at approximately 1.25 times, providing a significant financial buffer. Finally, the current valuation presents a compelling entry point. The stock trades at a depressed latest 12 months (LTM) enterprise value to EBITDA (EV/EBITDA) of approximately 9.8 times to 11.5 times, notably below its historical 5-year average of 13.8 times. This dislocation suggests the market has yet to fully price in the projected double-digit earnings growth and the scale benefits derived from the integrated enterprise. Corporate and strategic foundation, operational resilience. OK operates a vast network of approximately 60,000 miles of pipelines delivering essential energy products and services. The business is segmented into 4 primary reportable areas: natural gas liquids, NGLs, natural gas pipelines, refined products and crude, and natural gas gathering and processing. Midstream architecture and core competencies. The company's competitive advantage is rooted in the strategic placement and connectivity of its infrastructure. The NGL segment, a core business, operates approximately 15,000 miles of pipeline, supported by 40 million barrels (MMDL) of storage capacity and over 1.2 million barrels per day (BPD) of fractionation capacity. This infrastructure provides crucial value chain connectivity from the key supply hub of the Williston Basin down to the Gulf Coast. The natural gas gathering and processing segment manages more than 22,000 miles of pipeline and boasts approximately 7 billion cubic feet per day (BCFD) of processing capacity, with dedicated acreage across the Williston, Anadarko, and Permian basins. The combined refined products and crude segment, substantially enhanced by the merger, includes approximately 14,000 miles of pipeline, 53 refined product terminals, and 4 marine terminals, facilitating access to nearly 50% of the U.S. refining capacity. Contractual risk mitigation. OK's financial stability is maintained by a stringent contractual risk mitigation framework. All 4 segments operate primarily on a fee-based model. The NGL segment utilizes bundled service volume commitments and plant dedications, guaranteeing volume flow and revenue regardless of fluctuating spot prices. Similarly, the natural gas pipeline segment relies on fee-based demand charge contracts, which obligate customers to pay for reserved capacity, thereby generating resilient counter-cyclical cash flows. This structural design insulates OK's core profitability from the volatile energy commodity markets. Strategic rationale of the Magellan acquisition. The acquisition of Magellan Midstream Partners, finalized in September 2023, was a strategic move designed to create a more resilient energy infrastructure company with diversified cash flows. The transaction added Magellan's stable, demand-driven refined products and crude oil transportation business, which is highly valued for its low capital expenditure requirements and corresponding significant free cash flow generation. The combined entity now controls over 25,000 miles of liquids-oriented pipelines and possesses enhanced operational expertise across the Gulf Coast and Mid-Continent market hubs. This improved connectivity is expected to significantly increase international export opportunities and enhance customer product offerings. Management anticipates that the structural and commercial integration will yield total annual transaction synergies exceeding $400 million within 2 to 4 years. Non-operational financial advantages. Beyond operational integration, the acquisition provided a substantial non-operational financial benefit through tax optimization. The transaction structure resulted in an estimated $3 billion tax basis step-up for the acquired Magellan assets. This benefit carries an estimated net present value of approximately $1.5 billion. Functionally, this asset basis step-up is expected to defer the impact of the new corporate alternative minimum tax, pushing its effective date back from 2024 to 2027. This tax deferral provides a crucial near-term enhancement to cash flow. In the current highly leveraged environment, where aggressive capital deployment is required, this tax shield furnishes necessary internal capital, allowing the company to fund its substantial 2025 capital expenditure program, expected between $2.8 billion and $3.2 billion, while simultaneously navigating its commitment to debt reduction. IV. Analysis of the income statement and drivers of earnings. A critical evaluation of the income statement requires assessing historical volatility, normalizing for one-time events, and interpreting forward guidance. Historical revenue and operating income trends. OK's reported financials show substantial increases in both top-line revenue and core operating profit. Revenue surged from $8.54 billion in 2020 to $31.56 billion in the trailing 12 months ending September 30, 2025. Concurrently, operating income demonstrated resilience and growth, rising from $1.97 billion in 2020 to $5.91 billion TTM Q3 2025. The strong growth in operating income, despite global market volatility, highlights the effectiveness of OK's fee-based structures in converting physical asset utilization into predictable profit. Margin dynamics and commodity exposure. Despite the clear absolute growth in operating income, a closer inspection of gross margin percentages reveals temporary pressure during periods of high commodity price movement. For instance, the gross profit margin declined from 33.4% in 2020 to 22.14% in 2021. This decrease, occurring even as absolute revenue expanded rapidly, suggests that certain operating expenses, particularly the variable costs associated with energy use in processing and transporting product, are sensitive to commodity price fluctuations. These input costs can temporarily rise faster than the fixed long-term fee rates established by contract. This implies that while the revenue stream is shielded, the profitability margin remains susceptible to cost-side inflation. Margin recovery will be a key performance indicator reflecting the success of the synergy realization program. Normalization for extraordinary items. For accurate year-over-year comparison, 2023 earnings require normalization due to the financial impact of the Medford incident settlement. In January 2023, the company reached a settlement agreement with its insurer for total payments of $930 million, including $100 million already received in 2022. The total net financial impact on the income statement was positive $539.3 million, calculated as a one-time insurance settlement gain of $779.3 million, partially offset by an estimated $240 million in third-party fractionation costs. This non-recurring gain must be factored out to assess the underlying operational profitability of the core business in that period. Forward earnings outlook and reliance on adjusted EBITDA. The operational outlook is robust. Management guided 2025 adjusted EBITDA to be between $8.0 billion and $8.45 billion. Segment guidance includes an anticipated adjusted EBITDA of $3.13 billion for natural gas liquids and $2.20 billion to $2.32 billion for natural gas gathering and processing. This strong forecast underpins the analyst consensus for an aggressive 10% EPS CAGR through 2026, driven by contracted volumes and synergy realization. Due to the intensely asset-heavy nature of the midstream sector, significant non-cash expenses, particularly depreciation and amortization (D&A), weigh heavily on GAAP net income. The Magellan acquisition, which introduced substantial intangible assets, further amplified this effect. Consequently, adjusted EBITDA is the preferred measure of operational success. It provides a clearer view of the company's operational cash generation capacity, which is essential for meeting the large obligations related to debt service and maintenance of the dividend. This reliance on adjusted EBITDA as the primary performance metric is characteristic of prudent financial analysis in the energy infrastructure domain. IV. Comprehensive review of the balance sheet and capital structure. The balance sheet reflects the strategic decision to execute a large-scale acquisition, resulting in dramatically expanded scale and a temporary elevation of financial leverage. Scale and liability growth. The Magellan acquisition resulted in a substantial increase in the physical and financial scale of Oneok. Total assets grew from $23.08 billion in 2020 to $66.62 billion in the TTM ending Q3 2025. Total debt increased significantly over the period, growing from $14.34 billion to $33.73 billion, reflecting the financing required for the acquisition. Despite the increase in absolute debt, the total debt-to-equity ratio improved to 1.52 TTM Q3 25, down from 2.37 in 2020, primarily due to the equity components used in the merger financing and organic equity growth. Debt ratios and deleveraging mandate. The immediate priority for OK's capital structure is rapid deleveraging. Pro forma leverage measured by net debt to EBITDA was anticipated to reach 4.0 times at the close of 2024. The company maintains an investment-grade credit rating affirmed at BBB by S&P and Baa3 by Moody's. S&P noted that a downgrade trigger is set at 4.5 times leverage. Management has unequivocally committed to a targeted reduction of the net debt to EBITDA ratio to below 3.5 times by 2026. The narrow difference between the pro forma 4.0 times leverage and the 4.5 times downgrade threshold highlights the critical importance of this deleveraging plan. Maintaining the investment-grade status is imperative, as any downgrade would lead to increased borrowing costs, thus consuming cash flow needed for strategic investment and distribution. Therefore, the successful achievement of the $400 million synergy target is directly linked to balance sheet health, as the added EBITDA will rapidly accelerate leverage reduction and solidify the BBB rating. Liquidity assessment. Oneok's liquidity profile, characterized by negative working capital of minus $0.55 billion TTM Q3 25 and modest current ratios, quick ratio 0.66, current ratio 0.9, is typical for a capital-intensive midstream entity. These metrics reflect a sector structure where companies prioritize capital efficiency and fixed assets over high current asset balances. Liquidity is generated through the reliable flow of contractually secured CFO rather than reliance on short-term assets. Cash and cash equivalents stand at $1.20 billion TTM Q3 25, providing an operational buffer, but the financial strength is fundamentally derived from stable operating cash generation. V. Deep dive into the cash flow statement and capital allocation. The cash flow statement provides the definitive measure of OK's ability to self-fund its operations, growth, and dividends. Cash flow from operating activities, CFO, quality. CFO quality is consistently high, reflecting the contractual integrity of the underlying business model. CFO has demonstrated clear growth, increasing from $1.90 billion in 2020 to $5.66 billion TTM Q3 25. This reliable cash generation is the essential mechanism used to meet the company's heavy fixed financial obligations, including interest expense and maintenance capital. Capital expenditure dynamics and growth focus. Oneok is currently operating with a highly concentrated capital deployment strategy focused on long-term expansion. Total capital expenditures for 2025 are projected to be in the range of $2.8 billion to $3.2 billion. Capital spending is distinctly prioritized towards growth over maintenance. Maintenance capital expenditures required to keep existing infrastructure operational are guided to a narrow range of $475 million to $525 million for 2025. By contrast, growth capital expenditures are substantially higher, estimated between $2.325 billion and $2.675 billion. Significant projects fueling this spending include the relocation of a processing plant to the Permian, refined products expansions, and the approximately $520 million project to complete the remaining loop of the West Texas NGL pipeline. This NGL pipeline loop is projected to increase capacity out of the Permian Basin to 740,000 BPD and is expected to be in service in the first quarter of 2025. Free cash flow FCF stabilization. The heavy growth CapEx schedule has been absorbed by strong CFO growth, allowing free cash flow FCF to stabilize into robust positive territory. FCF reversed a negative outflow of minus $0.14 billion in 2020 to reach $2.91 billion TTM Q3 25. This substantial positive FCF demonstrates that the company's operating cash generation capacity is ample, even while funding significant organic growth projects. Strategic priority of growth CapEx. Management has made a clear strategic decision to prioritize massive growth capital expenditure, $2.3 billion to $2.7 billion, even as it manages a highly leveraged post-acquisition balance sheet. This trade-off is deliberate, reflecting the management's assessment that the expected returns on invested capital from these contracted growth projects, which enhance long-term capacity in critical areas like the Permian, are higher than the current cost of debt reduction alone. The successful completion and commissioning of these projects are the fundamental drivers required to achieve the projected 10% EPS CAGR and generate the future adjusted EBITDA growth necessary for long-term deleveraging. V. Dividend safety and sustainability analysis. The assessment of dividend safety for OK focuses on the coverage provided by distributable cash flow, the highest quality metric for the sector. Dividend history and commitment. Oneok is recognized for its long history of returning capital, having maintained or increased its dividend for over 25 years. The current annual dividend stands at $4.12. While the payout ratio against recent normalized EPS is approximately 75.29%, this metric is less informative than cash flow measures due to the significant non-cash D&A expenses inherent to the midstream business. Distributable cash flow DCF coverage. Distributable cash flow, DCF, is calculated by taking CFO and subtracting essential maintenance capital expenditures. DCF represents the true amount of cash available for distribution to shareholders. Based on historical guidance, DCF per share was positioned at approximately $5.15. Comparing this $5.15 DCF per share against the $4.12 annual dividend per share, 5, yields a strong implied coverage ratio of approximately 1.25 times. This buffer is critical, confirming that the dividend is securely funded by non-volatile investment-grade cash flows, even after accounting for the full cost of maintaining the existing pipeline network. The robust nature of this coverage buffer removes immediate concern regarding the long-term sustainability of the dividend. Future dividend growth constraint. While the dividend is safe, future growth may be limited in the immediate term. Recent dividend growth has been moderate, averaging 4.04% over the last 12 months. Accelerated dividend growth will be contingent on the profitable integration of Magellan and the successful commissioning of new high-return assets. However, the critical financial constraint on accelerating shareholder distributions is the mandatory allocation of surplus cash toward aggressive debt reduction. This cash is needed to ensure OKE meets its leverage target of 3.5 times net debt to EBITDA by 2026, which is necessary for maintaining its investment-grade status. 7. Valuation profile and investment recommendation. Oneok's current market valuation multiples suggest a discount relative to its historical performance, reflecting market skepticism regarding the integration and temporary leverage. Valuation via price to earnings. The LTM price to earnings ratio is currently between 13.01 times and 13.7 times. Historically, OK's PE has been volatile, ranging from 12.79 times in 2023 to a peak of 19.34 times in 2024. Relative to the sector, OK trades slightly above the industry average of 13.1 times, but remains below the average of its specific peer group, which stands at 14.9 times. Analysis further suggests the stock trades at a large discount to its estimated fair PE ratio of 18.7 times. Enterprise value metrics, EV to EBITDA dislocation. For the midstream sector, enterprise value to EBITDA, EV to EBITDA, is the most effective valuation tool. The LTM EV to EBITDA currently stands between approximately 9.8 times and 11.5 times. This current multiple is significantly depressed compared to the company's historical performance, where the 5-year average EV to EBITDA was 13.8 times and the multiple peaked at 16.2 times in 2023. The observation of a depressed EV to EBITDA multiple, 9.8x to 11.5x, juxtaposed against the anticipated massive 2025 adjusted EBITDA guidance, 8.0b to 8.45b, suggests the market is currently pricing in a significant execution risk premium related to the Magellan integration and the temporary high leverage, 4x. If management successfully realizes its expected $400 million synergy target and rapidly de-risks the balance sheet by moving toward the 3.5 times leverage goal, a reversion of the trading multiple toward the historical average is highly likely. This potential multiple expansion, coupled with the projected double-digit earnings growth, indicates significant capital appreciation potential. Valuation integrating growth, PEG ratio. Integrating growth expectations into the valuation provides a strong confirmation of the undervaluation thesis. Utilizing the estimated forward PE ratio of 11.74 times 8 and the consensus 10% EPS CAGR, the resulting price to earnings to growth ratio is approximately 1.2. This favorable ratio, especially for a stable, utility-like infrastructure company, confirms that OKE is undervalued based on its robust post-acquisition growth profile. Final investment conclusion. OKE Inc. offers a compelling combination of defensive, high-quality, fee-based cash flows and powerful structural growth catalysts not yet fully reflected in the market valuation. The company's dividend is safe, and its operational performance is robust. While temporary financial stress exists due to post-M&A leverage, management has a credible, mandated path to de-risking the balance sheet. The significant discount in the EV to EBITDA multiple suggests the market has yet to fully appreciate the combined entity's earnings power. Accordingly, OKE is recommended for investors seeking stable income and material capital appreciation driven by successful integration and realization of projected synergies.